Welcome back to the chapter 7, part B. We're going to talk about the cost allocation. Okay, so first of all, we wanted to know how to calculate depreciation of the tangible assets. Okay, so the first thing is, what is the depreciation? Depreciation in the dictionary definition means that it's decreased the value of asset because of usage. Okay. So accounting definition is the allocation of an asset's cost to expense over a time. So in other words, when you purchase of the asset, so the cost incurred to purchase, we talk about in the part A, is is the price plus the expenditures spent for get ready, right, to use. And when you pay such big chunk of money to get an asset, you will know that asset can serve you in the future period. It can benefit your operation in the future, such as you bought a land and you want to planting things on it. So the soil itself is gonna producing products for you, and then you can make money. Or you purchase a building and then you're trying to set up a retail store to rent to other people, so that cost incurred for the building is actually serving you for the future benefits. Or you bought an oil well, that oil well hasn't developed yet, and then you feel that is actually potential asset for you, so you develop that oil well and then you withdraw oils from the well. That cost that you purchased the well, the land where you think there's oil, is also can benefit you in the future potentially. Hence, this cost we call it asset cost, right? It actually benefits in the time period that you are using it. And then therefore, this cost in the accounting's definition is we wanted to allocate those costs into the future period when you gaining the benefits from these assets. So in other words, depreciation is a process that allocates a portion of the asset's cost to an expense over all period that's benefited, right? Because that asset, that piece of land, a piece of equipment, that oil well is serving you in the future to help you generating revenue to benefit you, right? Therefore, we wanted to depreciating the cost of you originally bought that cost into that period that you benefit from. Okay. So, for example, the local Starbucks pays $1,200 for a piece of equipment, say an espresso machine, with a useful life of 4 years. So then we need to record the depreciation for the first year. So how do we do that? We usually debit depreciation expense and we credit accumulated depreciation. How do we calculating that $300? Because this $1,200 equipment can benefit 4 years to generating espresso for us to sell for money. Hence that the next 4 years of this machine, this equipment is serving us, then we need to expense this 1,200 over 4 period of time. Therefore, we use 1,200 dividing 4 and we get $300. Okay. So balance sheet. So how does this transaction show on our balance sheet then? It show on our balance sheet by, first of all, we have equipment cost, right, for 1,200. That doesn't change. And then we set up, remember, the accumulated depreciation asset, depreciation for $300 for the first year, and then we use it a bracket which is minus under this account. And then the book value, the net value of the equipment right now become $900. And then this, as we always talking about a control asset account, this account always exists with equipment. It's like the twins, right? But the difference is the equipment is showing the original purchase prices plus the expenditure getting ready to use that expenditure, that cost. And then we always need a minus accumulated depreciation associated with that asset as a control asset account. And then when the investors look at this, the investor can calculating what the net book value of the asset is, which is $900 in this case. Okay, the common mistakes that students usually make is that they think that the accounting depreciation as recording a decrease in value of asset. No, depreciation in accounting is not a valuation process. It's not a value that's saying that the equipment is decreasing in value. It's actually essentially saying that depreciation in accounting is a logical process to allocating asset cost to expense over time. In another word, if you expense this $300 of that espresso machine, does not necessarily mean that espresso machine will really become only $900 at the end of the year. Okay, all you did is trying to rationalize that how much of $1,200 is actually spread into the first period of the year of usage to supporting the benefits that using that machine. It's different than the thinking of devalue that espresso machine. Okay, it's just an allocation of the cost process. It's not a valuation process. Okay, however, there's many things that we need to consider how to allocating the asset prices over its useful life, right? First of all, we need to have a concept called a service life. Service life is the estimated use of a company expect to receive from the asset before disposing it, such as the espresso machine probably if you're using on daily basis only sustaining for 4 years. That piece of equipment that you bought for producing iPhone probably at most can use for 20 years or 10 years, right? So we use the term that called service life and or useful life interchangeably because both terms are used in the practice. And residual value, or we call it salvage value. Salvage value or residual value means that amount that a company expects to receive from the selling the assets at the end of its service life. For example, if it's a piece of machine, usually you can even you cannot use anymore, you can sell as metal, and that cost can get you back about $500. Or if it's a building, if even you knock it down, you can salvage the bricks and the metals. That can give you back money about $1,000 or something. Hence, these two terminology is the most common one when we're describing long-term asset when we're trying to allocate the depreciation expenses. And the third most important thing is how do we considering the asset is depreciated. So in other words, the pattern in which asset depreciable cost is allocated over the time. So in other words, the depreciable cost is the concept that we use the cost of what we originally determined minus the residual value. And then depreciation method is how do we consider this depreciable cost is allocating over the period of time. So in order to determine how much of an asset of cost to allocate in each year, the company should choose a depreciation method that corresponds to the pattern of benefits receiving the future of usage. There's a 3 methodology in terms of depreciation method. We call straight line method, double declining method, and the activity-based method. And they are very interesting method, as you can see in one short. Okay, for right now, I want you to take away is that depreciation is meant that allocation of asset original cost to an expense during a period of benefit. It's not a valuation process. It's not a devaluating that asset. Okay, depreciation does not refer the change in the value or the selling prices. Okay. So let's look at what is a straight line method. Straight line means you only use one rate to depreciate the depreciable value over the period of useful life. For example, the or in other words, the straight line method is allocate an equal amount of depreciable cost to each year of the asset's life. Okay, so let's see this example. The cost of new truck is 40,000 and estimated residual value, salvage value is 5,000, and then we know the depreciable value of the truck should be 5,000, right? So we need to use the 40,000 minus the residual value. And I also know that estimated service life is actually 5 years, or they can drive 100,000 miles. Okay. So depreciation expenses for yearly, okay, under the straight line method is assets cost minus the residual value, get the depreciable cost, and dividing the service life for 5 years. In this specific example, it's going to be 40,000 minus 5,000 divided 5 years is getting us the $7,000 a year. Okay, so then we wanted to look at the schedule, depreciation schedule of this whole truck. So in the year 1, okay, we have a depreciable cost of 30,000, which is $40,000 minus the $5,000 equals 35,000. That's the depreciable cost. And depreciation rate is 1/5 is because this is the first year of the 5 year that you can use it, right? It give us 0.2%. Hence that the depreciation expense is gonna be equals $7,000, right? 35,000 multiple 0.2 is $7,000. And then accumulated depreciation account is gonna be the first time ever, right? So therefore you're gonna park $7,000 on depreciable accumulated depreciation because you were debiting in year 1 depreciation expense for $7,000, and you credit accumulated depreciation for 7,000, right? Hence that the book value, the net book value, this is net book value, will be reduced $7,000 from 40,000 to 33,000 because 40,000 minus 7,000 is 33,000, right? Okay, so the second year, same thing. The depreciable amount multiple the rate of 0.2, you're getting another $7,000 depreciation, same journal entry, right? And then the end of the year depreciation amount, because you have accumulated depreciation for $7,000 in year 1 and $7,000 in year 2, right? So that means the depreciation account by end of year 2 should be what? 14,000, and the net realizable value of the net value of the asset on the book should be 24,000, right? Because 33,000 minus because 40,000 minus 14, or 33,000 minus actual 7,000 is 26,000, right? So carry on to 5th year, so you will have a depreciated 4 years already by the time of the 3rd year, the 4th year. So, and then the total of depreciation should be 35,000 at the end of year 5, right? Year 5 is the end of the life of this truck. And then depreciable amount is still 35,000 multiple the rate of 0.2, it's getting the $7,000. And then because you have already depreciated the 7,000 on the 5th year, you depreciate the total amount of 35,000, and then your ending balance is actually 5,000, which is what you designed in the beginning, the residual value of 5,000. Okay, so partial year depreciation. So That means, what if the delivery truck was purchased during the year, say March 1st, and then used for 5 years? Then how do we do it? And then, as we know, the an annual depreciation amount is 7,000, but in the first year, we only use from March to December, which is 9 months, right? Hence that we will depreciate only portion of the year that held, so therefore $7,000 for depreciation month divide multiple 9 out of 12, so you're gonna be 5,833 for year 1. Year 2 to year 5, you have to depreciate all the $7,000 per year for 4 years, right? Year 2, year 3, year 4, year 5, this 4 years, and year 6, you will only depreciate the 2 months that left, right? Because look, you're starting late year 2, year 3, year 4, year 5, year 6. So you're starting in March, year 1. So there are only 9 months here, and then 12 months, 12 months, 12 months. Okay, and then this is catching up the 10 months. It's 10 months here. This is gonna catch up the 2 months in this is 12 months, 1, 2, 3, 4, 12 months, 12 months, 12 months, and 12 months. And then this one is gonna catching up the 2 months left in year 1. So therefore, year 6 is gonna be 7,000 multiple 2 over 12 equals 1,167, and then total it up, the depreciable amount should still equals 35,000. Okay, so I will show you guys in the class about how to calculate a portion or partial of year depreciation. Okay, so let's look at this one too. So how much depreciation should be recorded in the first year of delivery truck purchased on April 1st, and with the cost of $30,000 and expected life of 5 years, and advertising an estimated residual value of 5,000, assume it's a straight line method. First of all, we need to find the annual depreciation, regardless whether it's a partially year 1 or not, right? So the annual depreciation should be 30,000 as a purchase price minus the residual salvage value of 5,000 dividing 5, right? So it's going to be 25,000 dividing 5 is 5,000 a year. But because in year 1 we start at April 1st and then we use to December 31st, and there should be how many months? 12 minus 4 plus 1 is going to be 9 months, right? Because in year 1 we only used for 9 months. Hence we will use a $5,000 should be the yearly depreciation plus multiple 9 over 12. Then it's give us $3,750. Okay, so that's what it is. Okay. So common mistakes that students usually make is depreciate land. Okay, as I just mentioned in the last video, that land will not be depreciable because land is a service life is actually unlimited service life, so we don't depreciate land. Okay. Okay. So, and the third scenario happen usually in straight line depreciation is, what if people changing their mind about the asset? For example, because the depreciation is always an estimation, right? And we said it's only an allocation process of the allocation of cost process. It's actually subject to change, subjecting to re-evaluation. Hence that If there's a changing, say, in the terms of from 10 years estimated life to 12 years, that's possible, or the salvage value increase or decreasing differently from the initial year's decision, would that be allowed? Of course it's allowed. And then how do we deal with it? Let's look at this example. Assume that after 3 years of Little King sandwiches, its estimated remaining service life of the delivery truck to be 4 more years, right? So on the, remember it says only 5 years alive. Right now, on the end of the third year, the company feel like, oh, there's actually can use 4 more years, and for a total life of 7 years, right? And rather than originally 5 years. So, and also Little King changed their mind about estimated residual value from 3,000 to 5,000 about this truck. So how do we depreciate in year 4, right? So originally you say there's only 1, 2, 3, 4. Year 1, year 2, year 3, year 4, year 5. So at the end of year 3, you say, oh, actually, you know what? I can still using 4 more years. So year 6, year 7. So the life of this truck actually should be 4 years more. And plus the residual value increase from $3,000 to $5,000. And then, okay, then what are we gonna do? How are we depreciation here? How much depreciation expenses we should book in year 4? Okay, here is the process. First of all, by end of year 3, let's say the residual value, the net value, okay, of the book value. The book value here is actually, I wanted to alliterate it. This book value is actually the cost minus accumulated depreciation for the 3 years, equals $19,000. Now you minus the new residual value, 3,000, okay, instead of 5,000, you find that your new depreciation base it's become 16,000, and then because you have 4 years to go, right? 4 years to go, and then you're only dividing 4. Hence, the annual depreciation in year 4 to year 7 changed to $4,000. Okay, so, and then let's look at this is how we're changing the depreciation when there's a change in estimation. And it's actually not that difficult. Now you probably have a little bit confusing. When we go through the in-class exercise, you will be more clear. So the logic, the steps to take is the first of all, you figure out how much is left as of the year that you change the company changing their mind, the estimates, right? So therefore $19,000, you have to first figure out this number, and then you just treat this as a new, treated this as a new equipment with new residual value and new life, right? So the new residual value is 33,000, then you just minus 3,000, and the new life is 4, then you just dividing 4. Okay, all right, so let's move on to the double declining balance depreciation method. It's another way to calculating depreciation. Instead of using the straight line, which is equal amount for each year, this method, we wanted to introduce you accelerated depreciation. method, which is double declining method. In other words, we wanted to using higher depreciation in the earlier years. We want to have higher depreciation in earlier years of the assets, and lower depreciation in later years of the assets. Why is that? Because when the asset is new, of course it's more easy to use, and it's actually at the top of their life. They are functioning, they are bringing more revenues. Hence that the depreciation should be as much as the money that machine or equipment or building brings in. But when the assets actually in the end, almost close to the end of their life, the revenue they are generating is much less. Hence that we do not want to allocating too much cost on those later years. So that's the logic. And then the definition of depreciation method is actually means that we use the accelerated depreciation method. Double declining will have a higher than straight line depreciation in the early years, but lower than the later years. However, both declining balance, double declining balance method and the straight line method will result in the same total depreciation as over the asset of the service life. No matter what allocation method is used, the total depreciation over asset life will be equal to the depreciation cost. Okay, so no matter you use a straight line method or the double declining method, so the depreciable cost is always same, no matter what method you use. Okay, so let's look at what is the depreciable. Remember, the 40,000 is the we do not. So first of all, you need to remember the double declining schedule do not use depreciable costs at first year one. So if it's a 40,000, you use $40,000 to multiple the depreciation rate instead of 35,000. Okay, and the rate you call the double declining, of course, is actually 1 dividing 5 multiple 2. It's actually twice more faster than the straight line method. So it's gonna equals 40% a year. So you getting a depreciation expenses for $16,000 for the first year. Of course, you park that under the accumulated depreciation. Immediately, your book value become $24,000, right? Because 40,000 minus 16,000, and then the year two, of course, you use the book value, whatever left of this book value, whatever left, multiple the double declining rate of 0.4, and you get a 9,600. Hence, the accumulated depreciation become 25,600, and your book value decrease even more to 14,400. Year 3, you use 14,400 multiple the double declining rate, which is twice more than the straight line, which is 40% a year. So you get a depreciation expenses for that specific year 5,760, and you get in accumulated depreciation adding on from 25,600 to 31,360, and your book value is decreasing to 8,640. The fourth year, same thing, you use whatever the book value is actually equals 8,640 multiple 0.4, and you getting the 3,456, and the 3,456 adding the previous year's accumulated depreciation equals this year's accumulation as 34,816. And now your ending balance of the book value on that year of year 4 is actually for 5,184. Remember, your salvage value should still stay at 5,000. Hence, that your last year, the beginning value still is a 5,184, but your depreciation method cannot multiple the 0.4 anymore, because that's gonna be exceeding $184. In order to keep the ending value of the book value still stay at 5,000, you only depreciate $184. You only depreciate remaining difference between the book value and the salvage value, right? And at the end, you find out after you adding 184, your total depreciable amount still stayed at 35,000. So see, depreciable cost is the same for both methods. But if you notice, when you step away from this method, you can see that first of all, the amount that the depreciation expense is dropping very fastly, right? So the declining, that's why called double declining balances. So the depreciation expenses for each year is not gonna be same equally like straight line. It's declining very fast, right? And the residual value in the end still stayed at 5,000, and the rate that you use from year 1 to year 4 is actually double the straight line. Therefore, the name of this depreciation method is called double declining, double declining depreciation schedule, right? Okay. The common mistakes that usually students make when they use the declining balance method is that they commonly make the first year and last year of the calculation. Okay, here I wanted to tell you, first of all, in the first year, students sometimes calculate depreciation incorrectly, because as the cost minus residual value times the depreciation rate. No, this is not right, because in the first year we directly using book value multiple the double declining rate, right? So the correct way in the first year is to simply multiple the cost, which is 40,000, times the depreciation rate. Okay, this is the first mistake. Second mistake, in the final year, students incorrectly calculate depreciation expense in the same manner like early years, such as by multiple 0.4 here. Okay, it's wrong. So multiple the book value by the depreciation rate is wrong, because under the declining method, the depreciation expense in the final year should be the amount necessary to reduce the book value down to the residual value, which should be the last year depreciation amount should equals the book value minus the residual value. Okay, so that's the last year's depreciation method under double declining method. Okay, so let's look at the example here. How much depreciation should be recorded for the first year of delivery truck with a cost of 30,000 as expected life for 6 years and an estimated residual value of 6,000? Assume a double declining method is used. So in year 1, we said a double declining method is very simple. Just use the cost of that assets, multiple the declining rate, the straight line rate, right? So it should be equal to 10,000, right? Should be B, right? Because this is a straight line rate. It's a double declining, hence that we multiple 2, right? And then we use the costs, not depreciable costs here. We directly use the costs. Okay. So, and now we wanted to introduce you activity-based depreciation. Activity-based depreciation pretty much means that we, instead of using an asset cost based on, we wanted to depreciate the assets based on its usage. Like how much did you use it? So for example, we could measure the service life of a machine in terms of its output, right? So how many units or mileage this asset can serve us. And this method, it can be used for uh, machine production or trucks, right? So very simple. First, we just wanted to, instead of using the useful life, we use the mileage that this truck can serve us. So depreciation rate for average unit for depreciation cost, you're gonna be depreciable cost, which is the original cost minus the residual value, dividing total units expect to be produced. Basically, it's 40,000 minus 5,000 dividing 100,000. We understand is per every mile that truck drive, it costs us 35 cents. Okay, so therefore, in a year one, if you drove 30,000 miles, that means that you were depreciating 10,500, because 30,000 miles multiple 35 cents equals 10,500. In that year, you will have a accumulated depreciation for 10,500, and your book value will be reduced from 40,000 to 29,500. If then in year two you drove 22,000 miles, that means that you will depreciating in that year for 7,700, and your accumulated depreciation will increase from 10,500 to 18,200, and your depreciation, your book value will be reduced from 29,500 to 21,800. So on and so forth. By the time that you really drive the total of 100,000 miles, which say it's in year 5, or it can be year 10, it doesn't matter as long as you drove 10,000 miles. In the end, you will find out your residual value still gonna be 5,000, and your allocation will still always be in the 0.35 whenever however many miles you drive, right? You just multiple that, and then in the end, your total depreciable expenses should equals the depreciable cost of 35,000 in the end. Okay, this is easy as well. Okay, so we want to compare the depreciation method between straight line, double declining, and activity based. So the straight line, as namely, straight line is always straight, right? So straight means that every year you depreciate the same amount. Double declining, as name indicating, double declining means it's declining really fast, right? In early years we depreciate a lot, and in the later years we just depreciate it much less, right? It's declining the depreciation expenses. The activity-based depreciation method is very random, right? Because it's depends on how much you use the asset. So this is how it looks. But in the end, I just want to emphasize that the depreciable assets, depreciable cost is 3 method always the same. Is equals the price minus the residual value, right? No matter how you eat the pie, okay, you eat the same amount. Doesn't matter how do you cook the crab, you eat the way it's however it should be eaten, right? So there's a different way of cutting the same thing. You can cut a straight line, you can cut in double decline line, you can cut in activity based line. At the end, the total depreciation is the same under each method. And then I want to draw this graph to show you actually what we're doing here. If I actually draw the depreciation expenses, right? So you see the y-axis is the yearly annual depreciation expenses, and then the axis is the time, right? So therefore you can see the straight line method, which is the green line here, it looks straight because every year is the $7,000, right? And then when you look at a double declining, which is represented by the blue line here, the depreciation rate is actually decreasing. Oh, sorry, it's a red one here. The depreciation rate is going really fast down, right? declining. And at the same time, if you see the slope of the early years and slope of later years, you see the slope here, this year 1 is much bigger than year 4, year 3. This is because the rate is decreasing, right? Depreciation rate is much faster. And when you look at the activity-based, it's actually really random. It's up and down because it depending on the usage. So this graph is clearly shows us the depreciation behavior of 3 different methods. Okay, so let's see in the reality how company do it. In reality, how does the company choose depreciation expenses method? First of all, companies are free to choose the depreciation method they believe is the best reflecting the pattern of their assets life. Okay, and this illustration shows that the result of a recent survey how the depreciation method is used by large public accounting public firms. So in other words, straight line, 90% of the firm using it. Okay, and second of all, like only about 4% of people using double declining, and activity based even less than double declining, and others pretty much combination of 2 different methods. So then you will ask me why there are so many companies that are directly just using straight line method. Probably because this company believe that they realize the benefits from their planned asset promising evenly over these asset service lives. Okay, certainly another motivating factor is that a straight line is the easiest method to use, and it's very easy to calculate. And another thing, a positive thing about the straight line is the reported income under the straight line method is actually higher net income, higher than the net income for double declining in the earlier year of life, asset life. The higher net income can improve the bonuses of the management, right? Increase stock prices, reduce likelihood of violating the debt agreement. So another way means that the double declining method under is actually the net income. The net income, oops, sorry. Net income is smaller than this net income, right? Because remember that example, the truck was like $7,000 per the year 1. And then this guy had like $16,000 per year 1, right? So therefore, when the company we talk about the management always wanted to boosting the net income, so therefore they are more likely to choose this one because this one can give them much higher net income in early year of the asset they purchased. Okay, so to elaborate on it a little bit more. Accelerated method reduce the taxable income more in the earlier year of the asset life. Hence, most company trying to take advantage of this. First of all, they use a straight line method for financial reporting purpose, and then they use the accelerated way to tax purpose. So we call this MACR markers, right? So in another way, it means that as a result, the company used a straight line for the financial reporting, and for the Internal Revenue Service prescribed the accelerated method for income tax purpose. Thus, company record a higher net income using straight line in depreciation, and a lower taxable income using double declining balances in early years of the asset life. Okay. So takeaway: straight line declining balance and activity depreciation are all acceptable depreciation method for financial reporting purpose, and most of the company using straight line depreciation for financial reporting, and accelerated method called the MCRS markers for the tax reporting purpose. Okay, so After we talk about the tangible asset depreciation method, then we have to talk about amortization. Instead of depreciation, depreciation is a terminology for the tangible asset, like buildings and equipment, right? And then for intangible asset, we want to call it amortization. Okay, so amortization is also same thing, allocating the cost of most intangible assets to expense. It's called allocating the cost of most tangible asset to expense is called depreciation. Allocating the cost of intangible assets to expense is called amortization. Okay. Most intangible assets have a finite useful life, and that can be estimated. For example, patent, we say it's 20 years, right? Patent, and usually trademark is renewed every 10 years, and then some of them have a very limited life. And we say that the copyright is life of the creator plus 70 years, right? That's the copyright, right? So all these things are estimatable intangible assets. So most companies using a straight line amortization for intangibles. There's no complication for double declining or activity used base. Okay, so let's using an example. Amortization of a franchise. In early January, Little King Sandwiches acquired franchise rights from University Hero for $800,000. The franchise agreement is for a period for 20 years. Record amortization for the first year. Okay, very simple, right? Instead of writing down the depreciation, because this is an intangible asset, because we're getting a franchise right, we call amortization expenses for debit side, and then we credit the franchise itself. We do not creating accumulated depreciation account. We directly write down the intangible assets account, right? We credit that out. And how did we get 40,000? Is because we use 800,000 divided 20 years. Okay, so amortization of a patent. Let's see. In addition, Little King purchased a patent from meat slicing process for $72,000. The original legal life of the patent was 20 years, and there are 12 years remaining. So when they bought it, there's only 12 years left. The 8 years was used for somewhere else, or it's already 8th year of this patent application of that patent, right? However, due to expected technology obsoletes, the company estimated the useful life of this patent only 8 years more. Okay, Little King using straight line amortization for all the intangible assets, record the amortization for the first year of the 8th year that the Little King estimated. So same thing, debit amortization expenses, credit patent, and we're using 79,000 that they purchased at, and dividing the 8 years that they estimated this meat slicing process is good for. Hence, we get $9,000 and directly write down, directly reduce the patent. Okay, directly. There's no cumulated depreciation. There's no such thing called accumulated amortization for intangible assets. Okay, you directly credit the value of the intangible assets. Okay, and with that being said, we don't depreciate land. I wanted to remind you again, because the land has an unlimited life. Similarly, we do not amortize intangible assets, those with unlimited life. Okay, for example, the asset's useful life, when the asset has an indefinite life, okay, or there's no foreseeable limit on the period of time over which that we expected this asset will contribute into the cash flow of entity, and we will not amortize those assets. Okay, for example, suppose Little King acquire a trademark. Okay, that trademark was supposed with indefinite life. Okay, and there's a trademark that with the server finite lives. We consider When we consider life of Little King's trademark for its name to be indefinite, we do not amortize it. But when we find out that the trademark they purchased from someone else has finite life, we amortize it. Okay. And another thing I wanted to talk about between intangible assets, the ones that are not submitted to amortization, is this goodwill. Okay, this mysterious account, goodwill account. Goodwill is most common asset that does not have unlimited life or indefinitely useful life. Recall that we measure good life as the difference between the purchase price, right, and purchase price minus the fair value of net asset of the company that we acquired from. So does that mean that the goodwill and other intangible assets with indefinitely useful life will remain the company's balance forever? Probably not, because managers must review long-term assets for potentially write-off when there's events or changing circumstances indicating that the asset is actually recorded more than what is really worth. Okay, the recoverable amount is the cash expected to receive from future assets over its remaining useful life. In other words, all long-term assets, okay, are subject to impairment rules, and we will discuss more in details in the appendix of this chapter. So in other words, intangible assets, when it's actually subject to a finite useful life, we were using straight line method to write them down. However, when there's intangible assets not subject to amortization life, such as goodwill, we will always periodically review whether the cash flow purpose, the benefits of bringing future cash flow is still valued or not. And if it's actually going decreasing, we will record impairment. Means that, for example, if in next 50 years the Apple in the future is not Apple today, then the goodwill parked on the Apple's asset side probably need to write down, right? Because they are decreasing. So that is actually another topics that we were expanding if you are taking intermediate 1 class. But at here I want to stress that amortization is a process similar to depreciation, in which that we allocate the cost of an intangible asset over their estimated service life. An intangible asset with an indefinite life or infinite life, such as goodwill and most trademarks, are not amortized. Okay, so which of following intangible asset would not be subject to amortization? Okay, B, right? Because the indefinite life means that you cannot amortize it. Okay, so we finished second part of this chapter, and I will talk to you guys in the third part. We will mainly talk about at the end of asset life, how do we deal with them? We call it asset disposition. We can sell them, we can retire them, or we can exchange for something new. Okay, talk to you in next recording.